feels like a real reassessment going on in the markets now of where Fed pricing is concerned, or at least their targets for rate hikes are this year, and perhaps the fact that the markets was a little bit behind the curve here.
Yeah, the reassessment is really interesting because markets tend to want a narrative to focus on. And the current narrative is, my God, inflation is right around the corner and the Fed's going to hike a lot faster than you think. And I wanted to bring some sanity to the discussion. I wrote a note that said, you know, if you look at all the job growth that's taken place since 2010, about 45% of it has been in three sectors, the low-wage sectors, hospitality, retail, and healthcare. What's happened in the last year is that retail has really not accounted for so much of the growth because of the Amazon kind of effect. But these low-wage sectors are not the source of higher inflation. And then when you look at GDP growth, you say, well, there's been a lot of consumption and investment, but if you look at consumption, a lot of that's been financed by a drop in the savings rate. And that savings rate is now at historically low levels of 2.25%. And investment, well, that adds to aggregate supply. So why is that inflationary? So when you think about the narrative that the markets are really focused on, the underpinnings of that narrative are really quite questionable. Will inflation be higher? No question it's going to be higher. Will it be higher immediately? Absolutely not. Will the Fed react to it? We don't know, because how nervous is the Fed about being behind the curve? Right now, it doesn't seem like it's all that nervous, but the markets are pushing the anxiety levels way up there, and you can see that from the re-rating of the 10-year.
Yeah, and also we have a new man in charge of the Fed, so there's that added question mark there as well. I want to pick up on your point about the investments, the corporate investments not necessarily leading to inflation, mainly because they invest in software and equipment that create efficiencies. So, Bill, does that mean that the tax cut that we got at the end of last year will spark another round of investment spending? It's expected to, at least. Will that also result in more efficiencies, something that limits the rise of prices?
That's what theory says, right? I mean, the hope and a prayer about the differentiating of investment versus consumption spending is that consumer spending is aggregate demand. It pushes up prices, it pushes up the economy toward capacity. Investment spending increases productive capacity. And what's unique about the increase in investment spending now is that a lot of it is going into technology, software, and equipment, which means we're modernizing capacity, we're increasing the productive capacity of the economy. That's exactly what everyone's been calling for. When you increase aggregate supply, how can that be inflationary, right? So you have to ask the question, is all this GDP growth going to be inflationary? The answer is no. The investment part of it, I think, will be tending toward increasing supply, so that limits the amount of inflationary pressure that's going to be out there. And the reason why the tax reform has been so important is that the tax reform is incentivizing less debt financing and more equity financing, and that pushes the corporate managers out there to be more long-term. They're going to go for productivity-enhancing investments rather than just incremental additions to capacity.